So for today, we're going to be looking at a stock that has fallen by almost 80% since its COVID all-time highs. Okay, and this stock is none other than PayPal. Main reason for the sell-off, is very simple. The actual earnings has actually been going down. A very good morning to you, everyone. Okay, my name is Brian from The Boring Husband. Okay, PayPal is a very interesting company, and I think of late, with the so-called crash in its stock price, it does warrant a second look at it. So, at the onset, the main reason, for the sell-off, is very simple. As we all know, during COVID, everyone can only pay online, right? So obviously they grew. After COVID, so we're looking at 2021, towards the mid 2022 they couldn't sustain that growth, and hence the revenue is still increasing, but that kind of net margin, along with the actual earnings, has actually been going down. So that's a very bad thing. And furthermore, the pace of revenue increase has not been as high as before. So people no longer see PayPal as like this super big payment giant, and as a result, bit by bit they sell off until pretty much where we are today. But in terms of fundamentals, in terms of, let's say we take the most basic, and that's a PE. Currently they trade at a PE of 19. Once again, of course, everyone, if you say that PE 19 is very cheap, that's complete crap. You always need to compare PE with someone else. Now in this case, the closest competitor that I can think to PayPal, will be Stripe. But as we all know, Stripe is not listed yet. So the only other options I have is Square, which is Block. But Block once again has no PE. If not, it'll be Visa and Master. So Visa and Master trade respectively at 27 and 32 PE. So to say that PayPal is cheap relative to its competitors actually has some weight to it, because they're trading at 19 whereas others are trading at above 19. Secondly, one metric for these financial providers, it's called total payment volume. The acronym is TPV. Now, the problem with TPV for PayPal is that it has been going down. And in my research, I have managed to narrow this to two reasons. So number one, TPV is going down because discretionary spending is going down. So meaning to say that now inflation, everybody losing their job. So everything that you wanted to buy, you stop buying all those things that you don't need. Hence, it's discretionary. So when the things that you don't need, you stop buying. All in all, this causes payment volumes to kind of drop. One interesting thing about total payment volumes falling, is the fact that competition has increased. So let's look around us. If you go to Amazon, correct, you got the Amazon one-click checkout. If you go to Shopify, they got Shopify whatever nonsense, Shopee Pay, Alipay. For all you know, tomorrow also there'll be a Brian Pay. So everybody has their own payment gateway now. Last time, there used to be only PayPal, correct? They used to be they're on top of the world. But now every other company out there is doing their own payment gateway. Even your FANG stocks, like your Facebook, Google, the best example in this case that really came in to disrupt their little seat at the top is Apple Pay. And actually one of my favorites is actually Samsung Pay, because Samsung Pay you can get the points, they can exchange for soybean milk. So all these competitors that come in, they flood the market. Consumers now have so many more options. PayPal don't have that, right? No matter how much I use PayPal, they're not going to give me a soybean milk. So obviously as a consumer, I'm going to use other people out there. Hence, PayPal by and large is falling. But in terms of the qualitative analysis for this company, PayPal is still operating in a payment gateway industry that it is still considered to be relatively asset-light, means your marginal cost of production is very little. And at the end of the day, they are still trying their best to kind of keep up with times. And this is very interesting because for those of you that used to stay or live or work whatever holiday in the US, you would definitely have come across this app called Venmo. Venmo is, think of it as a privatized Pay Now Pay Lah. So very simple, just one click, send people money back and forth, etc. Now Venmo is doing very well in the US. Everyone is using it. I don't know why. And recently, right, Venmo actually created a little spin-off called I think Venmo Teen or something. Basically to even the moment the kids go primary school, right, they already have this kind of payment app. And this is great because with this kind of payment gateway apps, right, you are looking at the lifetime value of a customer, correct? It's so of course you have little things to kind of entice them, but as time goes by, they stay, they use your app, they transact on a day-to-day, and this is exactly what PayPal is trying to do. They're realizing that so my PayPal brand is more for boomers, or older people like myself, but young people think that PayPal is not cool. So you need other brands, like Venmo, etc. And that's exactly what they're doing. I think it's very interesting. Next thing also, I think that until today, PayPal has a very strong network effect. Meaning that somebody use it, more people use it, and then the whole thing gets better and better. PayPal is very interesting because they serve predominantly two markets that they earn money from. Let me give you a very simple example. PayPal used to be on eBay, right? Okay, very simple. So eBay is here. Okay, the customer pay money to eBay, correct? PayPal takes a cut of that, and then from eBay they pay money back to the merchant. PayPal also take a cut of that. So it's very interesting. Both sides, they're earning money, and to me, I think that's pretty fantastic. But that's one of the things that really set them apart. But today, of course, we are seeing other players come in, to disrupt the market and all. But at the end of the day, PayPal is still, okay, by and large, in terms of fundamentals, okay, the company revenue is still going up. Okay, earnings, okay, a bit shaky. Q2 2022, they suddenly report like some negative earnings, no one knows why. Okay, earnings is margins starting to fall. Okay, that does raise some cause for concern. Okay, but by and large, in my opinion, I don't think there's anything severely wrong with their revenue. Okay, I just think that the biggest problem here is that revenue is growing at a lower pace than before, hence the stock price is being punished. Okay, so this kind of sums up, okay, the fundamentals. By and large, every earnings, okay, that they done, okay, they kind of beat analyst expectations, okay, by a little bit. So far, still pretty alright in terms of that. But basically, the biggest problem here is now, how we justify, this massive sell-off, and whether this is the right time for us to enter. Okay, with that, we look at the technical analysis. Alright, so if you look at the chart, you see the top here. Okay, so double top, so that's like 300. See guys, I told you all, psychological resistance level. You see, the stock bounced off at exactly 305. Okay, so it's always about the mind. Okay, so this is what you call a double top formation. Okay, over there and over there. Okay, and we see the stock has, look at the massive sell-off since 2022, 300 now all the way to 64. So if you buy this stock today, you are officially buying it at 2018 levels over here. Okay, and to me, of course, okay, one can argue that if you want to look at like super strong support for the stock, you're looking at like what, 30, 40. Sure, if the stock falls to that range, then so be it. Okay, this is the weekly chart because I find the daily chart very noisy. But okay, let's just take a quick look at the daily chart. We look at the moving averages, okay? Lime green line is the 200-day moving average, and dark blue line is the 50-day moving average. So we can see that the moving averages, they are starting to like trade a little closer to each other, which indicates that the stock could be finding its bottom soon. Okay, but of course, if you really want to see a very convincing signal that it's time to buy, then you probably want to see these two moving averages start to slope up, okay, before you buy. Most important, risk to reward. Okay, the lowest it can go from here, theoretically speaking, is 40. Okay, so you're buying at 60, you have a $20 gap for it to drop. And then of course you say $40 is your stop loss level, then okay, so be it. But if not, if it goes all the way up, then it's going to be all the way up to like the hundreds. Okay, so in my opinion, the risk to reward, okay, for PayPal, okay, is definitely very favorable to the investor in terms of the charts. Okay, so overall, okay, payment gateways in general, the industry is still growing, okay, 10% on a year-on-year basis. All in all, payment gateway providers are being punished very severely. Okay, and in my opinion, okay, I think that the stock is now trading well below its relative valuations. I think that the risk to reward definitely is favorable to the investor, which is why I've been buying this stock lately. Okay, but once again, this is not a recommendation for you to buy or sell. Okay, instead, this is just something that I've been doing. So I may be right, I may be wrong, only time will tell. Okay, once again, all the money that I use, okay, these are my savings. So of course, when I buy, when I sell, I do want to make sure that I am safeguarding this, just as much as I would safeguard my loved ones. Okay, with that, have a great weekend ahead, and we'll see you in the next video.